Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Sorrento Therapeutics stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Sorrento Therapeutics researches human therapeutic antibodies for the treatment of cancer, inflammation, autoimmune, and pain diseases. The company is also developing potential antiviral therapies and vaccines against COVID. They are headquartered in San Diego, California, and founded in 2009. The ticker trades on the Nasdaq, Deutsche Borse, and London Stock Exchange. Let's get started with the model. This is a small cap company, 1 billion market cap. They're trading at $3.46 a share, and they have 306 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They're not bringing in that much revenue at this point, so they do have negative free cash flow every year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is the sales for the company, and that does grow each year from 21 million up to 51 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Cost of labor is a big cost of revenue for this company. Revenue minus cost of revenue gives you your gross profit, and that grew from 14 million to 39 million. Below that is our operating expenses. Research and development is a big operating expense for this company. Gross profit minus operating expenses give you your operating income, and that is negative each year, and the negative is getting worse. A loss of 129 million down to a loss of 330 million. Below that is the interest they pay in their debt, and that was the lowest in the trailing 12 months at 10 million. It was 58 million in 2018. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. A common item in this category is an asset impairment. Below that is their pre-tax income, then their taxes. And below that is their losses from their investments in other companies. A loss of 300,000 in the trailing 12 months. In 2020 was a loss of 6 million. Earnings from equity interest is generally when you own 20 to 50% of another company. If they owned more than 50% of another company, then they would consolidate that company's entire financials onto theirs. But if they own less than 50%, they can use equity method accounting or cost method accounting. And the bottom line of the income statement is their net income, which is negative every year. This is the income statement from the latest quarterly report. The first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. Their revenue was 12 million, a little higher than the third quarter of 2020. In the first 9 months of 2021, it was 40 million. In the first 9 months of 2020, it was 28 million. A bulk of their revenue comes from their subsidiary, Skillex. That was 7.5 million. In 2016, Sorrento acquired 72% of Skillex for $48 million. And this company is focused on the development and commercialization of non-opioid pain management products. They received 3.2 million of revenue from Concordis. Sorrento acquired Concordis in 2013, and they gave them $11.3 million of stock. Their revenue from Bioserve went from 1.5 million to 1 million. The expenses directly tied to generating the 12 million of revenue were 1.2 million and 2.2 million. That gives Sorrento a gross margin of 72%. Gross margin is gross profit over revenue, and that's a lot higher than the median and average in the industry. A bulk of a pharmaceutical's expenses are in R&D. That was 49 million in the third quarter of 2021. They also spent 49 million in SG&A, selling general and administrative expenses. This includes payroll for its staff, also the rent and insurance for its facilities, and that gives them a 101 million operating loss, which is worse than last year of 83 million. But this is to be expected as a company is growing and trying to develop new drugs. This is their statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. So they leaked 250 million of cash flow in the trailing 12 months, and it's getting worse each year. They spend anywhere from 10 to 40 million in CapEx. CapEx is investments in property, plant, and equipment. Operating cash flow minus capex gives you your free cash flow. And of course, they have negative free cash flow each year. So they're mainly running their business on issuing stock. They issued 84 million in 2018, 48 million, 318 million, and 240 million. Every time a company issues common stock, it dilutes the current shareholders. It makes your shares less valuable. They did add a lot of debt in 2018, but it looks like they're trying to pay down their debt. They paid down a lot of debt in 2020 and the trailing 12 months. This is their operating cash flows from their latest 10Q, the first 9 months of 2020 and the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net loss, then you have to add or subtract the non-cash items on the income statement. We have to add back depreciation and amortization. We have to minus 12 million on the Skillix note. They passed through a $17 million gain on marketable investments. We have to minus that out here. Their big non-cash item is stock-based compensation. This is when you pay employees with stock. It is dilutive, so it does increase the shares outstanding, but it's a non-cash item because the company doesn't have to pay for its own stock. We also have to adjust for changes in working capital. They reported an accounting loss of 284 million, but they lost 210 million of cash flow. Most of the time, operating cash flow is better than net income. Same thing in 2020, net loss of 241 million, negative 119 million of cash flow. This is the investing and financing sections from their statement of cash flows. Acquisitions appear in the investing section. They spent 754,000 on one company and then 35 million on other acquisitions. They received 124 million of cash from marketable securities. Companies usually invest in short-term liquid securities, so the cash doesn't sit in the bank earning no interest. In the financing section, they received 135 million from issuing common stock. They added 35 million of debt. They received 13 million from options and warrants. And they paid down 72 million of debt. So they had a cash inflow of 110 million. Last year was a cash inflow of 186 million. This is the equity section on their 9/30 balance sheet. They have 132 million of equity. They raised 1.4 billion from selling their business, and they lost 1.2 billion from running their business. They also bought back $50 million of common stock. When a company buys back common stock, they put it in the equity section as treasury stock. This brings down their equity balance. Let's look at the capital structure. 132 million of equity, 200 million of debt. They're 39% equity, 61% debt. They could pay off a lot of their debt with the cash on their balance sheet if they wanted to. And I gave them the highest whack on Finbox, 10%, and that's a discount rate we're going to apply to the future cash flows. We estimated a little over 3 years of future free cash flows. We also estimated a terminal value, which is all cash flows past 2024, that's 2.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2 billion. We divide that by 306 million shares. And we get a calculated stock price of $6.45. They're trading at $3.46, so they're trading at a 46% discount. It's a buy according to the model. Their revenue is projected to grow 118%. So I grew it by 118% for the next few years. That's how I got their future revenue estimates. The average company in their industry converts 30% of their revenue into free cash flow. So I multiplied their 2024 revenue by 30%. That's how I got their future free cash flows. And I assumed they would have negative free cash flow in 22 and 23. Two analysts priced this stock both at $26 a share. This is where the stock has been trading the last 2 years. This is a really highly shorted stock, and it looks like there was a short squeeze because the stock got up to about $19 a share. So you can see it does move around a lot, but it's trading at a pretty low point. There were lots of investors bullish on this company because of all the research they're doing on COVID, all the drugs and vaccines they're trying to develop for that. It's not common for a CEO to defend itself against short sellers. But that's what this company's CEO did, and the stock went up 12% when he did that. He said to the short sellers, "Don't ruin your family by shorting my stock." Recently, the company received a purchase order from Mexico for 10 million COVID testing kits. There are many pharmaceutical stocks that are not selling any drugs, but this company has received FDA approval for some drugs and are selling them. And they have lots of drugs in their pipeline. But it's really hard to identify which drugs will get FDA approval, and how successful they will be. Here's a visual from one of their presentations. They separate their drugs into 3 categories: non-opioid pain management, COVID-19, and immuno-oncology. They're working on 6 different COVID-19 drugs. So that is really promising for this company and their stock. The stock is really volatile. It has a beta above 2, so the stock moves more than 2 times the market. It's gone down 75% in the past 52 weeks, while the S&P is up 18%. The 52-week low is 280, the high is 17, and the stock is trading well below its 50-day and 200-day moving average. This is a really popular stock. Over 10 million shares are traded each day. Of the 306 million shares outstanding, 276 million are on float. 24% are held by institutions and almost 14% are shorted. A good sign is when a company is adding employees, and their employee count is mainly going up through acquisitions. They currently employ 502 people. The general public owns 64% of the company, institutions 28%, insiders 5%. And public and private companies about 3%. BlackRock is the biggest shareholder at 7%, 21 million shares valued at $72 million. Then Vanguard, State Street, the CEO, and Geode. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a high price to sales of 21. That's stock price over sales per share. The way to calculate sales per share is revenue over shares outstanding. This means investors are paying $21 for $1 revenue. Their price to book is okay at 8.1, that's stock price over book value per share. To calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet, it's assets minus liabilities. Their tangible equity is negative 242 million because they've done a bunch of acquisitions, so they have a good amount of intangibles on their balance sheet. Let's look at their non-current assets. They have 46 million of property and equipment, 77 million of operating leases, 320 million of intangibles, 53 million of goodwill. Goodwill is the premium you pay when you acquire another company. It's the acquisition price minus net assets. Net assets is assets minus liabilities. They have 51 million of equity investments. This is their investments in other companies. Equity investments is when you own less than 50% of another company, and 5 million of other assets. Their current ratio is 1.1, so they can cover their current liabilities with their current assets. Also, their quick ratio is 1.1. Let's look at their current assets. 40 million of cash, 123 million of short-term marketable securities, 16 million of accounts receivables. This is how much money other companies owe Sorrento. 5.4 million of inventory, 12.2 million of prepaid expenses. This means Sorrento made an advance payment for a product or service that's going to be received in the future, and 4 million of other. Let's look at their current liabilities. 28 million of accounts payable. This is how much money Sorrento owes other companies. 17 million of accrued payroll. This is how much money Sorrento owes its employees. 24 million of accrued expenses. These are expenses Sorrento has incurred but hasn't paid yet. 2.3 million of deferred revenue. This is when a company prepays for a product or service before it's delivered. 11.6 million of operating leases. 66 million of contingent considerations. This means Sorrento has to pay another company if a certain event occurs. For example, if it sells 1 million doses of a certain vaccine, then it has to pay a third party a fee. And 28 million of debt. They had negative 269 million of free cash flow in the trailing 12 months and only 26 million of working capital. In order to get through the next 12 months, they're going to need to raise some equity or issue some debt. The best way to look at ratios is to compare them to companies in the same industry. There are 713 companies in the same industry as Sorrento. Sorrento spends more than the average company in CapEx. They're a lot more leveraged than the average company. Of course, they don't pay a dividend. Their free cash flow is worse than average. In terms of market cap, they're ranked 125th. These are the top 19 companies in terms of market cap. And then I put Sorrento down here on the bottom. Their price to book is worse than average. That should be red, not blue. We can't look at their price to earnings or price to free cash flow. They do have a better price to sales than average. They bring in a lot less revenue than the average company. Their 3-year annual growth rate is 14%, which is lower than average. and they have a bad ROA and ROE since they have negative net income. So to summarize, I have them trading at a 46% discount, and it's really hard to value companies like this that don't have consistent positive numbers because they're still growing. So you can either 10 or 20x on this stock or lose most of your investment. If you invested a year ago, you would have lost 75% of your investment. But you could have made a lot of money because the stock was up to over $15 a share at one point. A good way to value this company is try to follow their pipeline of drugs, but I would have no clue how to value a drug and figure out if it's going to get FDA approval or not. But the good thing is they are selling some drugs, and they seem to be acquiring a lot of companies, so they are actively growing their business. I rank their free cash flows 1 out of 10, their revenue 4 out of 10, and their ratio is 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.